So welcome back home.
Oh, thanks. I actually miss your guys' show when I sit in Beijing, but
really?
It's great to be back. And as you say,
yeah.
You know, Africa is certainly deeply entwined with the trajectory of the Chinese economy. It's, you know, Africa's largest trading partner. It's the biggest investor in the continent. So, you know, the reason I'm here is because we're seeing more and more of our clients are starting to query this risk of a hard landing in China. And we just wanted to come and sort of touch base with our clients and let them know that we do think that the risk of a hard landing is increasing.
It's increasing, but when we talk of hard landing, we always say soft landing, hard landing, and when we look at 7.2% growth, you know, some people say that it's getting very dramatic, that we keep talking about a hard landing. Is this as soft as the growth is going to get in China? And we've even heard, you know, I mentioned it a bit earlier, where government officials are going to be pumping in more money on infrastructure spending and doing what they can to stimulate the Chinese economy. Is that going to be enough?
You're exactly right in the sense that from a cyclical point of view, I'm personally quite comfortable with the pace of moderation. Markets seem to think that Q1 was going to be the bottom in the cycle. I personally believe Q2 is likely to be the bottom of the cycle, and we're likely to see a sort of shallow recovery. And the government itself is comfortable with a 7.58% growth rate, which is unusual. And I think that the Chinese government has taken a step back and said, no longer do we want this growth at all costs kind of economic model, and we want to give ourselves space to deal with some of the structural risks that have accumulated in the Chinese economy over the last couple of years.
So you're talking about potential bubbles within the Chinese economy?
The investment, non-performing loans, real estate bubble, the role of consumption going forward, and NPLs on the bank balance sheet. These risks are real, and that is why we think that over the past 12 months, the risk of a hard landing has increased. But
then why then drop the bank reserve requirement ratio once again if we do see NPLs increasing, if there is worry about specific bubbles in various areas?
Well, the reserve requirement ratio is one of the tools that the Chinese government has to kind of support the banking sector in times of need. So right now it's, you know, 20.5% of reserve requirement ratio. It's come down 3 times since November. And the reason that they reduce it is to inject liquidity into the system. But I would warn that a lot of people think, you know, that the PBOC is just simply going to come and backstop economic growth in China if the downturn occurs. And what we've really seen is we've seen only 3 cuts in the reserve requirement ratio, 1 every 2 or 3 months. Very gradual, very slow policy maneuvering from the Chinese government. And I think the reason is because China wants to just gradually deal with the slowdown in the Chinese economy, because what's happened in China is it's become increasingly complex. It's now 60% bigger than it was in 2007. The economy is more complex, it's more diverse, and as a result, getting out in front of all these problems is more difficult than it was previously.
Absolutely. So now that we see this softness coming through, and perhaps, as you allude to, a more prudent stance by the People's Bank of China, let's touch on how this is going to affect the African growth story. We know we've seen a lot of investments, a lot of interest. Are we going to see a slowdown in Chinese investment and FDI into Africa?
I think FDI is a unique situation because it's driven by structural factors that have little to do with the cyclical story that we're talking about. Africa is one of the few places where we are open to Chinese investment. We can play an important role in the passive diversification away from US denominated assets. We're part of the renminbi internationalization program. Our projects offer long-term future cash flows. So the Chinese recognize that there are a lot of opportunities in investing in Africa. And China is one of the few places in the world that actually has the capacity, the capital, and the wherewithal to actually invest in Africa. So I think from an investment point of view, you're not likely to see much of a pullback, even in a hard landing scenario, because the capital is there and is available for SOEs to go out into Africa.
Okay, so let me ask you this. If we do see some dramatic, you know, downfall in the Eurozone, and I have to mention Greece, and we're really worried about the overall Eurozone scenario, where does that leave China? And then if we have that scenario playing out, so something dramatic happening in the Eurozone, coupled with a hard landing in China, what then?
That's exactly the point. I mean, previously in the recession in 2008 and 9, China was a bastion of strength, and it placed a floor under commodity demand.
Absolutely,
for
and the saving grace of world growth.
Exactly, and especially Africa. That's why China-Africa trade increased as a share of our total trade, because they were there to kind of step into the mire and support Africa. This time round, you have if you have a hard landing in China, what's going to be the counterweight? And it's not going to be Europe. As you know, the Eurozone continues to sort of go through these periods of rupture. They're not in position to support global growth. And you have a slowdown in the US, in China, you have a recession in the Eurozone. That's going to certainly push the US economy from 2.5% growth into stall speed, and that could then cause a serious problem for the global economy. Okay,
what about the consumption-led story, where we've got consumption story coming through very strongly? We look at some of those luxury goods operators that currently are doing very well in China, fantastic profits coming through. What about the actual consumer story?
The consumer story is really quite a paradox, because obviously, as you know, consumption to GDP is just 35%. So it's the lowest in the world. But at the same time, you've seen consumption in China grow the fastest in the world since since 1990. It's growing at a compound annual growth rate of 8% every year, consistently over and over again. And the reason is China's consumption story is certainly powerful, but what we've seen is the investment story has been even more powerful. And to counterbalance a fall in investment in China is going to be very difficult for consumption, given that consumption is 35% of GDP and investments 50% of GDP, and you don't have export sector being able to support. So the composition of the Chinese economy is in quite a difficult position, and that is why we still continue to sort of express ourselves saying the hard landing is feasible, even though it's not our base case.
Fantastic. We have to leave it there, so thank you so very much, Jeremy. Great to have you on the program.